Welcome to Industrial Alliance Investment Management's April's macroeconomic and market update. On discussion today is our investment team's take on major market movers of the past quarter and our outlook for the rest of 2022. My name is Rose Marcello and my client portfolio manager at IIM. Joining me for this conversation is Sébastien Mahon, Vice President, Asset Allocation and Chief Strategist, Senior Economist and Portfolio Manager. Sébastien oversees a variety of managed multi-asset solutions for IIM's clients. Thank you for being here, Sébastien. So early in the year, you had already made a call for global growth to slow down in 2022. With the unforeseen geopolitical events of late and their consequences on the global economy, how have your expectations evolved for the rest of the year? And what are your expectations for the major asset classes?
Thank you, Rose. It's nice to have you on board, and hello, everyone. So, yeah, an important call this year was what was going to happen with the global growth. So, at the beginning of the year, our favor leading economic indicators, just like the one that you're seeing on your screen right now, the Chinese credit cycle, we're pointing towards a slowdown of the global economic cycle in 2022. So, the Chinese credit cycle is an interesting one because the Chinese authorities have pretty much their hand on the dial for more credit, less credit, so they're having a strong impact on global growth. So this is what the chart is showing us here. The red line is Chinese credit cycle. As you can see, it was pointing towards more and more weakness towards all the way towards the end of 2022, and now pointing towards a rebound of the global economic cycle somewhere or in early 2023. So this has a lot of implications, especially for how much risk you want to be taking in your portfolio. So when you have an economic slowdown on the global scale, you generally want to have less equities in your portfolio, and this is exactly what we did. So if you look at the table that's showing up on your screen right now, so on the left you have our current positioning, on the right you have our 12-month forward views. So our current positioning right now is to be overweight cash, overweight money market, so we have some dry powder. Whenever an opportunity will arise, we'll have money on the side to take advantage of it. We're underweight fixed income, so rates are rising with central banks already started their tightening process. So we're underweight fixed income. We're neutral equities. We like Canada, we like emerging markets, we like a little bit less the US and Europe, so that's neutral for equities, but with more Canadian and emerging market equities, less US and European equities. So this is how we're positioned, but looking forward in the next 12 months, probably with rates rising, at some point there will be an interesting opportunity to add fixed income to the portfolio. So we might be at some point neutral bonds, neutral fixed income in the portfolios, and we might return also to an overweight in equities. So with less of an underweight like we have right now on US and in Europe. So there are some good opportunities that are coming up, but as we are sliding down this economic slowdown, we think it's a good time to be neutral right now.
Great, thank you for that. Well, now, given the dazzling rise of interest of late, there's a lot of chatter in the markets about curve inversion, recession, and whatnot. What's your take on those fears, and what's your assessment of recession risk at this stage?
Sure. So there was a lot of buzz recently about the yield curve inverting. It was the 2-year versus the 10-year rate that had inverted. Right now, as we're recording this mid-April, it's not the case anymore. We know that the inversion of the 2 to 10 has usually led recessions by 6, 12, 18 months, depending on the situation. So we like to look more at a 3 months, 10-year curve. We think that this one is much more precise in calling the inflection points for the economy. So when it inverts, usually a recession follows not too far after. And what it's telling us right now is that there's 1.8% gap between these two rates. So there's ample room for central banks, the Fed, the Bank of Canada, to tighten before it risks pushing the economy over the brink. So far so good. So we think there's still ample room. The risks of a recession are not as high as one might think, although they are still rising. So right now we'd say between 30, 35, 40% in this vicinity. So it's not the base case, but it's getting more significant, and it's rising. So the chart on the right, just to conclude, you have so this is the survey of economists by Bloomberg. So the forecast for growth in 2022, gray, blue, this is Europe and the US. As you can see, revisions are getting much lower as we move forward. So more downbeat on the European and US economy. The red line is the Canadian economy, not much negative revisions. So we think Canada could still do well because high commodity prices is helping the Canadian economy, and it could do better than elsewhere around the world. So that's why we still prefer Canadian assets versus foreign assets for now, at least.
Good news for Canada. Thank you, Sébastien.